Have you ever looked at two investments and thought they both made about 10% last year, so what's the difference? The answer may have a lot to do with standard deviation. Standard deviation sounds complicated, but the basic idea is actually very simple. It tells us how much an investment returns tend to move around. In other words, it helps us understand how consistent or inconsistent an investment has been. And today we're going to discuss what standard deviation is and not make it complicated. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investments. If you're new here, subscribe to my channel and hit that like button. So let's start with two investments. Imagine I give you two investments. Both have an average return of 10%. But here's what happened with their yearly returns. Investment A earned 9%, 10%, 11%, 10%, 10%. And here is investment letter B, minus 10%, 25%, 5%, 20%, 10%. Both average about 10%. But would you say they're equally predictable? I think not. Investment A stays close to about 10% per year. Investment B jumps all over the place. And that's where standard deviation comes in. How much do those returns move away from the average return? The closer the returns stay onto the average, the lower the standard deviation. The farther away they move, the higher the standard deviation. That's really the main idea. Now here's another way to think about it. Imagine you're throwing darts at a target. If all your darts land close together, you have a very little spread. That's like low standard deviation. Now imagine your darts are scattered all over the place. Now your standard deviation is far apart and it's higher. So standard deviation is basically a measurement of how spread out the results are. It doesn't tell you whether the investment made money or lost money. It tells you how much the results moved around. Standard deviation is one of many metrics used by Theta Bridge Capital Management when managing non-directional investment portfolios, with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. So why does investors care? Well, suppose two investments both have the same returns of around 10%. Investment A has a standard deviation of 5%, and investment B has a standard deviation of about 20%. Which one is more volatile? Very simple, investment B. Why? Because its returns have historically moved around much more. And that matters because volatility can make an investment harder to live with. You might perfectly be happy with an investment that averages 10% over time. But if getting that 10% means experiencing some very large ups and downs, you may not be comfortable holding on to it. That's why investors need to look beyond the average return. Standard deviation is not a prediction. There's an important point here. Standard deviation is based on historical data, and it doesn't predict exactly what will happen next. For example, if an investment has a standard deviation of 15%, that doesn't mean the investment can only move 15%. The market can move much more than that. Think of standard deviation such as a measurement of past behavior, not a guarantee about the future. It's telling you this is how much these returns have tended to move around in the past, around their average. Let's say you're comparing two investments. Both have an average return of 12%. Investment A has a standard deviation of 6%. Investment B has a standard deviation of 18%. Investment B has experienced much more variation from its returns. So you might say investment A has been more consistent. Investment B has been more volatile. That doesn't automatically mean A is better than B, because higher volatility can sometimes come with higher potential returns. The important thing is to understand how much variability you are accepting to pursue your expected return. And here's where things get even more interesting. You might own several investments. One investment could be very volatile. Another can also be very stable. But what matters isn't just how volatile each investment is individually. It also matters how they move together. For example, if one investment tends to go up, others go down, combining them together may reduce the overall volatility of the portfolio. And that's one of the basic ideas behind diversification. You're not simply trying to find investments that have low volatility, you're just trying to build a portfolio where the investments work together. And one final point, Standard deviation is useful, but it doesn't tell you everything about risk. I like to think of it as one instrument on the dashboard. You can also look at it: beta, how the investment moves compared to the market; maximum drawdowns, basically how far an investment has fallen from the previous high; and correlation, how investments move in relation to each other. So here's the easiest way to remember standard deviation. A low standard deviation equals returns tend to stay closer together. A higher standard deviation equals returns tend to be more spread out. Or even simpler, standard deviation is a way of measuring how much an investment tends to move around. The next time you see an investment with a 10% average return, don't just ask, how much did it make? Also ask, how much did it have to move around to get to that place? Because understanding return is important, but understanding risk is just as important. To learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.